It is a prudent strategy for investors who seek to mitigate downside risk while maintaining the potential for upside gains in their stock holdings. How about using bull call spread to speculate in stock markets? This strategy involves buying a call option and selling another call option with a higher strike price, but the same expiration date. It's used when the trader is moderately bullish on the stock. What is the objective of using a bull call spread in stock options trading? The objective of using a bull call spread in stock options trading is capitalizing on a moderate bullish market outlook. This strategy involves buying a call option at a lower strike price and selling another call option at a higher strike price, aiming to profit from a modest rise in the underlying stock's price. The primary goal of the bull call spread strategy is to profit from a moderately bullish outlook on a stock. It involves buying a call option with a lower strike price while simultaneously selling another call option with a higher strike price, both having the same expiration date. This strategy aims at capital appreciation by capitalizing on moderate upward movements in the stock price. How does the bull call spread strategy fare across various market conditions? The bull call spread strategy is most effective in moderately bullish markets. It is designed to generate profits when the market experiences a moderate increase in prices, but it may not perform as well in flat, highly volatile, or bearish markets. The bull call spread strategy is most effective in moderately bullish market conditions. It is designed to benefit from a steady but not explosive rise in the stock price. This strategy may not be as effective in highly volatile or bearish markets since significant price swings can undermine the controlled profit mechanism set up by the spread. What risks are involved in a bull call spread strategy? The risks involved in a bull call spread strategy are limited and defined. The maximum loss is the net premium paid for the spread. This is the cost of the long call minus the income from the short call. While the risk is controlled, the profit potential is also capped at a certain level. The risk associated with a bull call spread is limited to the net premium paid, which is the cost of the long call minus the income from the short call. The maximum loss occurs if the stock price is at or below the lower strike price at expiration. However, the strategy also caps the maximum profit at the difference between the two strike prices minus the net premium paid. What rewards can be expected from a bull call spread? The rewards from a bull call spread can be maximized gains within a specific price range. The maximum profit is realized if the stock price is at or above the strike price of the short call at expiration. The profit is the difference between the strike prices minus the net premium paid. The reward potential of a bull call spread is the difference between the strike prices minus the net premium paid. The best case scenario occurs when the stock price is at or above the higher strike price at expiration. However, traders should be realistic and understand that the maximum profit is capped, and the return on investment depends on the stock's price movement within the selected range. What key steps should be considered when implementing a bull call spread in stock options? Key steps in implementing a bull call spread include choosing the appropriate strike prices and expiration dates for both call options, assessing the cost of the spread versus the potential profit, and monitoring the underlying stock's price movement relative to the spread's break-even point. It's important to align the strategy with the investor's market expectations and risk tolerance. To implement a bull call spread strategy effectively, traders should Identify a stock with a moderately bullish outlook. Buy a call option with a lower strike price that aligns with the current bullish sentiment. Simultaneously sell a call option with a higher strike price, ideally where the trader believes the stock price will rise but not exceed. Choose options with the same expiration date to create a spread. Calculate the net premium paid and understand the maximum risk, or the net premium and maximum reward. Profit potential, which is the difference between strike prices minus net premium. Monitor the stock's performance and be prepared to take action if market conditions change significantly, affecting the outlook. A bull call spread in stock options trading requires a clear understanding of the stock's potential price movement and a moderate bullish market outlook. It offers a balanced approach with limited risk and controlled profit potential, suitable for traders who are bullish on a stock but not expecting dramatic price surges. Let's discuss bear put spread to speculate in stock markets. Similar to the bull call spread, but with put options. It involves buying a put option and selling another put option with a lower strike price. This strategy is used in bearish market scenarios. What is the primary objective of the bear put spread strategy in stock options trading? The primary objective of the bear put spread strategy in stock options trading is profiting from bearish market movements. This strategy involves buying a put option at a higher strike price and simultaneously selling another put option at a lower strike price, aiming to benefit from a decline in the underlying stock's price. The primary goal of the bear put spread strategy is to profit from a bearish outlook on a stock. This involves buying a put option at a certain strike price while simultaneously selling another put option with a lower strike price. The strategy aims for capital appreciation by exploiting expected downward movements in the stock price. How does the bear put spread strategy perform under different market conditions? The bear put spread strategy is ideal in bearish or declining markets. It is designed to generate profits when the market experiences a downturn. However, in bullish or flat markets, the strategy may not be as effective. The bear put spread is most effective in bearish market conditions or when the market is expected to decline. It allows traders to benefit from a drop in the stock price within a certain range. This strategy is less effective in bullish or highly volatile markets where the stock price is likely to rise or fluctuate significantly. What risk is associated with the bear put spread strategy? The risk associated with the bear put spread strategy is limited and defined. The maximum loss is restricted to the net premium paid for the spread, which is the cost of the long put minus the income from the short put. This makes it a controlled risk strategy. The risk in a bear put spread is limited to the net cost of the spread, which is the cost of the long put minus the income from the short put. The maximum loss occurs if the stock price is at or above the strike price of the long put at expiration. The defined risk nature of this strategy makes it attractive for traders who wish to limit potential losses. What potential rewards can be expected from a bear put spread? The potential rewards from a bear put spread are gains within a specific price range. The maximum profit is realized if the stock price is at or below the strike price of the short put at expiration. The profit is the difference between the strike prices minus the net premium paid. The reward potential in a bear put spread is the difference between the two strike prices minus the net cost of the spread. The maximum profit is achieved if the stock price falls to or below the strike price of the short put at expiration. However, traders should set realistic expectations, understanding that profits are capped and dependent on the degree of the stock's price decline. What are the key implementation steps for a bear put spread strategy in stock options trading? Key steps in implementing a bear put spread include selecting appropriate strike prices and expiration dates for both put options, calculating the net premium paid and the potential profit, and monitoring the underlying stock's price movement relative to the spread's break-even point. It's crucial to align the strategy with the investor's market expectations and risk tolerance. Effective implementation of a bear put spread strategy includes selecting a stock with a bearish outlook, buying a put option with a strike price reflective of the current market sentiment, simultaneously selling a put option with a lower strike price, determining where the trader expects the stock price to decline but not fall below, choosing options with the same expiration date to establish the spread, calculating the net cost or the premium paid for the long put minus the premium received for the short put to understand the maximum risk and potential reward, monitoring market conditions and being ready to adjust the strategy if the market outlook changes. A bear put spread in stock options trading offers a strategic approach for traders who expect a stock price to decline, allowing them to capitalize on this movement with limited risk. The strategy is suited for those seeking to benefit from bearish scenarios while maintaining control over potential losses. Let's discuss the straddle strategy to speculate in stock markets. A straddle is created by buying both a call and a put option with the same strike price and expiration date. This strategy profits when the underlying stock makes a significant move up or down. What is the objective of using a straddle strategy in stock options trading? The objective of using a straddle strategy in stock options trading is profiting from significant market movements in any direction. This strategy involves buying both a call and a put option with the same strike price and expiration date, allowing the trader to benefit from large price swings regardless of the direction. The primary goal of a straddle strategy is to profit from significant movements in the stock price regardless of the direction. By buying both a call and a put option with the same strike price and expiration date, traders position themselves to capitalize on large moves either upwards or downwards. This strategy is often used for speculation, particularly in situations where high volatility is expected, but the direction of the market move is uncertain. How does the straddle strategy fare across various market conditions? The straddle strategy is most effective in highly volatile markets. It thrives when the market experiences significant movements, as large swings in either direction can lead to substantial profits. In contrast, in low volatility markets, where significant price movements are less likely, the strategy may not be as profitable. Straddles are most effective in highly volatile markets, where significant price movements are expected. This could be in response to an impending earnings announcement, economic report, or any other event that could lead to substantial market fluctuations. Straddles are less suited to stable markets where significant price movements are unlikely. What risks are involved in a straddle strategy? The risks involved in a straddle strategy include balancing the high cost of setting up the strategy, since it involves buying both a call and put option with the potential for unlimited gains. The break-even points for the strategy are further away due to the double premium cost, making it necessary for the stock to move significantly in either direction to realize a profit. The risk of a straddle strategy lies in the combined cost of purchasing both the call and the put options, which can be substantial. If the stock price does not move significantly, the trader may incur a loss equal to the total premiums paid for the options. However, the potential gain is unlimited on the call side and substantial on the put side, up to the strike price minus the premium paid if the stock goes to zero. What rewards can be expected from a straddle? The rewards from a straddle can include high gains if the stock moves significantly in either direction. The strategy's profit potential is theoretically unlimited on the call side and substantial on the put side, limited only by the stock reaching zero. The reward potential of a straddle is highest when the stock makes a significant move either up or down. The best case scenario is a sharp rise or fall in the stock price, well beyond the total premiums paid, leading to substantial profits. However, traders should consider the average expected return, factoring in the likelihood of significant price movements and the cost of the options. What key steps should be considered when implementing a straddle in stock options? Key steps in implementing a straddle include choosing a stock with potential for significant volatility, selecting the appropriate strike price and expiration date for both the call and put options, and timing the entry to coincide with expected market events or conditions that could trigger substantial price movements. Monitoring the market and adjusting the strategy as needed are also important. Implementing a straddle strategy effectively involves identifying a stock or asset likely to experience significant volatility, buying a call and a put option with the same strike price and expiration date. The strike price is typically chosen close to the current stock price, considering the cost of both options as the initial investment can be significant. Monitoring market events and price movements closely, as timing is critical in executing profitable trades with straddles. Being prepared to act quickly following significant price movements to capitalize on the strategy's potential. A straddle strategy in stock options trading requires an understanding of market dynamics and the factors that can lead to significant price movements. It is a strategy best suited for traders who anticipate high volatility but are unsure of the market's direction, offering the potential for high returns at the expense of higher upfront costs.